Hello, this is Desmond Leon with the Metro St. Louis Community Tax Coalition in conjunction with the St. Louis Tax Assistance Program. This presentation relates to the state resident credit, non-resident, as it relates to the TaxSlayer software. The objectives for this session is that you'll know the theory of the resident credit, how it comes about, calculating the resident credit, which the software will normally take care of, and the impact of city earnings tax on the resident credit. Okay, going to the next slide. This slide here discusses the logic and the theory behind the resident credit. So this point here is that the individuals are taxed in the state of employment and in the state of residence. This results in a double tax. Stated another way, you as an individual can be taxed in the state where you work and where you live, resulting in a double tax. So it's not uncommon for border states like Missouri, where you would have clients that work in Missouri, living in Illinois, residents, clients that work in Illinois who lives in Missouri. Same way with Kansas City, Missouri, and surrounding cities in the state of Kansas. The purpose of the resident credit is to eliminate or to reduce the double tax. We compare this to a part-year resident. During the calendar year, individuals may move from one state to another. This is what you would define as a part-year resident. For state tax preparation purposes, and unless the person moves to or from a state with no income tax, there will be at least 2 part-year returns. So, stated another way, there's no such thing as a resident of one state and a part-year resident of another. That's kind of like an oxymoron. So, you will have a resident-non-resident relationship, as well as you would have 2 or more part-year resident returns, unless one of those state returns is a state that has no income tax. So, once again, on terminology, the non-resident state is the state of employment, and there may be more than one. We've had clients that work in multiple states, such as construction workers. The resident state is where the client lives. And as I indicated about the part-year resident, not uncommon for individuals to move from state to state. They work on projects and move on to other locations. The last item of terminology is the amount of income tax that's paid to the other state. This has probably been one of the more difficult concepts, and I'm hoping that this will clarify it. So, oftentimes when I'm dealing with volunteers and trying to explain it, they often will take the withholding off the W-2 as the amount of income tax that's paid to the other state, because in your mind that, well, if you paid it over, then that must be the income tax that's paid. Well, withholding is it's a deposit. So what that amount of income tax paid to the other state is, what it's not the state tax withholding that's on the W-2 or the Form 1099. Keep in mind, withholding, it's a deposit against the state taxes that are owed. So if you withhold too much, it results in a tax refund or an overpayment. Or if you withhold too little, that results in a balance the due, meaning that you owe tax. What it is, it's the another way of saying what the amount of income tax paid to the other state is it's the state tax on what you owe if you had no withholding. So again, what it is it's the state tax on what you owe if state tax withholding is zero. And then for those of you that are in the business of taxes and are volunteering and are familiar with reading IRS transcripts, it would be transaction code 150. And transaction code 150 says this is the amount of the tax that is on the tax return that you owe, simply put. So hopefully that will clear it up. Now, this screen here is a combination of narrative and screenshots from the TaxSlayer software. So point number one is when adding the state tax return, you can classify the return as a resident state, the resident return, or non-resident. And that's where you're talking about please choosing a return type. In the resident state return, you're going, one of the items that you have to indicate is the non-resident state. So the place where you live wants to know where you worked. That's what bullet number 2 is about. The state that you lived in wants to know where you worked. And you're going to find this in the credit for income taxes paid to other state in that section of the software. The other item that's going to be asked for is in the non-resident state. It's going to ask for the resident state. Stated another way is the state that you worked in wants to know where you live. And typically you're going to find this question that you'll have to answer. That's going to be in the state's basic information screen. By taking care of these 3 options here, you are creating the linkage within the software that allows that credit to correctly calculate. So from part 2 of that data entry process, I advise you complete the non-resident state first so that you can identify the amount of income tax that's paid to the other state. Then you complete the resident state. In this case, it would be Missouri. Now, TaxSlayer will compute the Missouri resident credit. I do suggest that you go back and look at the copy of the return to see that the Missouri credit is calculated correctly. 2018, 2019 software, TaxSlayer has done a very good job in computing that. It carries forward and you can pretty much rely on it. Now, city earnings tax is puts a little wrinkle on the resident credit. So this will impact the Illinois resident that is working in St. Louis City, and it will impact Kansas residents that's working in Kansas City, because St. Louis and Kansas City each has a 1% earnings tax. So how does the city earnings tax relate to the resident credit? Well, the city earnings tax is 1%. So, however, the Illinois and Kansas tax rules allows the city earnings tax to be considered as an amount of tax paid to the other state. Even though it's paid to the other city, it's paid to the other state also. So, TaxSlayer is not programmed to add that city earnings tax in. So you as a preparer will have to then manually add the amount from the W-2 of box number 19 to the amount of tax paid to the other state. This has the impact of increasing the resident credit, but it will only increase the resident credit to 0. You won't get a refund. All it will do is offset the state income tax amount that's owed. It will offset it to 0, but it will not give you a refund. And I note that so because the tax rate is effectively higher in Illinois than Missouri, Illinois residents that work in Missouri generally will have a balance due. The additional 1% city withholding helps the Illinois resident to reduce the balance due. And this screen here combines 3 different screenshots of the Illinois software. In the upper left-hand corner is a screenshot of the Illinois resident working in the city of St. Louis, and it shows that the amount of credit for taxes paid to other state is $2,438. But then just to the right of that, on line 29, where you see the $1,904, line 29 and line 31, 1904 is the amount of actual tax that is paid to Missouri. There's a W-2 that shows an amount of city tax of $534, and then at the bottom left shows that the $2,438 is manually added in order to calculate the Illinois credit. So city earnings tax requires a manual the data entry. Here again is a screen of the state situation where you have to choose between resident, non-resident, or part year. So this concludes the resident credit discussion. Thank you.